Good morning, everyone. This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the day's schedule of events for Friday, March 4th. Well, it's nonfarm payrolls day. The U.S. nonfarm payrolls for February come out at 13:30 GMT. It's the biggest economic indicator of the month, as the market assumes that the Fed's looking closely at this indicator to judge whether to raise rates further. Now, personally, I don't think employment is much of an issue for the FOMC anymore. Looking at their forecast in December, they estimate the long-term level of unemployment to be 4.8 to 5%. It's now 4.9%. In other words, it's exactly at what they estimate to be the long-term sustainable level. In other words, they think this is about as low as unemployment can go sustainably. It means they've hit half of their mandate, full employment. And they should be focusing instead on the other half, stable prices. So in my view, the inflation data should be more important than the employment data, but people don't necessarily see it that way. In fact, the unemployment rate could go up as the labor market improves and draws more unemployed people back into work. That would be a normal response and nothing to get excited about. Some FOMC members have even raised the possibility that the NFP figure could start to fall as the labor market tightens and it gets harder for companies to find workers. Now, the indicator that connects the Fed's two mandates, stable prices and full employment, is the average hourly earnings figure. Average hourly earnings should, in theory, go up as the labor market tightens. And as earnings go up, companies should, in theory, raise their prices. That's why, in my view, the average earnings figure is probably more important than the NFP figure itself. The market expects the monthly rise, the month-on-month rise in average earnings to slow, but for the annual rate of change to continue at the same strong pace as it was in January. Now, continued strong gains in wages should reassure the FOMC that the labor market is indeed tightening and make them more confident about hiking rates further. That would probably be positive for the dollar. In any event, Fed officials constantly say that they have no preset schedule for rate hikes, but rather that it all depends on the data. The U.S. data has indeed been gradually improving recently, and the market has accordingly started to reprice the possibility of the Fed tightening further this year. Another good NFP figure would certainly help to make that case. Assuming that the data come in anywhere around the market expectations, I believe they will be positive for the dollar. Also, at the same time, the U.S. announces its trade balance for February. The market expects the U.S. trade deficit to widen out again. Both imports and exports are falling, but with the U.S. economy still growing faster than most other economies, it's natural that U.S. exports will be falling faster than U.S. imports. That suggests a wider trade deficit for some time to come. It's not good for the dollar, but it doesn't seem to hurt at this point either. Canada announces its February trade balance at the same time as the U.S. data come out, and then at 1500 GMT, the IVPMI is released. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.